Welcome to today's Corporate Venturing Insider Series. Today, I'm super happy to have Arvind with us, who was co-chairman of the GCV Leadership Society and who's going to give me guidance as I'm taking the chairmanship for the next 2 years. Arvind, welcome.
Thank you, Nicolas. It's great to be here. Happy New Year. And, you've already brought so much energy to the corporate venturing ecosystem with everything that you do, that I think it's going to be great to have you as the chairman next year. And I look forward to your leadership there. And I'm sure you'll have fun doing it.
Thank you so much. And you also brought a lot to the ecosystem, not just the co-chairmanship, but also you joined our podcast, you've written about corporate venturing, you've been very generous with all of us. But today it's one more chance for you to be generous and share how you see the ecosystem. You have a very interesting vantage points of corporate venturing across many, many years and many investments and engaging with the mothership and adding value. So let me start with very high level helicopter view. How do you see the ecosystem in the last 10 years? How is it matured? What are the challenges still that you see?
Yeah, absolutely. And very happy to be, given this opportunity to speak on this subject. And I've been doing this for a little while, for coming up on 15 years here. It's suffice to say that the environment is so different than when I first started. But one of the interesting things is venture capital itself and corporate venturing has changed a lot in those 10 to 15 years, and frankly, for the better. It's a much more mature industry to the extent that we can call it an industry, right? It's a much more mature practice. A number of companies, understand why they need to do it. That's why the number of corporate venture firms and corporate venture teams have grown dramatically in the last 10 or 15 years. And the other thing I think about going back 15 years or even prior to that is corporate venture used to be mostly in the tech world, right? But as software has come into every industry, and now every industry is impacted by the tech spaces. In other words, every industry needs the corporate venture unit to make sure that they're keeping tabs on how their particular industry is getting disrupted by startups. And secondly, the companies are much more mature, with, folks like yourselves or our team, bringing in specialists who think about this day in and day out, can go deep, can structure it in the right way, can think about how to derive that strategic benefit to the companies that we serve. I think that that's become a specialty of its own. It's not a hobby. It's not a side job for somebody. It used to be that way a long time ago. It no longer is the case. But the other thing about venture capital and corporate venturing, Nicholas, is we live in the venture capital in the tech market like everybody else. It doesn't matter if you're a institutional venture firm purely driven by financial returns or you're a corporate venturing unit. You live in the venture capital world. You live in the tech markets. You live in the ups and downs. And so, we're in an interesting part of the cycle. In 2022, we saw that sort of downturn. It was kind of quiet for the next 2 or 3 years. And then AI started to pick things back up. And then towards the second half of 2025, leading up all the way to December 31st, you saw M&A activity. We will see if that continues into 2026. So I think there are interesting things to consider there as you think about how a corporate venturing unit is positioned within this broader ecosystem.
Yeah, and you're not wrong about the activity towards the end of the year. As I shared with you, we had a $20 billion moment with Grok being acquired for licensing and teams with NVIDIA. Now, I want to so the audience is clearly people who are in corporate venturing or people who want to enter corporate venturing. And there will be many CEOs of big corporations listening. And it nearly feels like the question is no longer, can you afford to have a corporate venturing unit? It starts to become more about, can you afford not to have one? Could you make the case as to when a corporation really need a corporate venturing unit and why they should think about it now versus not?
I think I referred to this a little bit in what I was saying earlier about the advent of technology in every aspect of our lives and hence in every industry, every sector. Sometimes strategy teams within the business looking at sort of various aspects of how the company or the business unit needs to be thinking about growth and changing towards, looking at industry changes and so on and so forth. I think that the one aspect that was missing from those strategy teams, and that continues to be the case today, is they're very good at looking at macro factors. They're very good at looking at the changes in the industry and big aspects of strategy, capitalist strategy. But what they're not probably looking at is what's happening in the world of technology that can impact their business. What's happening in the world of startups that impacts their business. And needless to say that in every industry, you've seen startups come in that have completely changed how some aspect of that industry or maybe the industry itself. And we certainly see that in parts of financial services. And so it becomes an important aspect of strategy, right? And so that makes it important for corporations and for CEOs and boards to ask the question, hey, what's happening in the startup world in this area that's going to impact us tomorrow? And I think that that's where the corporate mentoring unit comes in and becomes a part of the answer.
Very nice. Let me follow up on one thing you said about it doesn't matter where it sits. I'm sure you do have some opinions about best practices about where the reporting line should be and where it could help the mothership depending on where it sits. Could you maybe share, especially for the CEOs who don't have a CBC yet, but they're thinking about it? How should they think about where it sits and how it should be supporting the rest of the organization?
I think it's a great question, Nicholas. And I think this is an area where no two companies will be similar in sort of how they think about it, because no two companies are similar in their organizational structure, and I think that is almost the bigger part of it. Making sure that you have top level support, you have the support from the CEO and the mandate from the CEO to be involved in the activity, but then building that credibility and support also at the business unit leader level, and maybe even below that level where perhaps the product decisions are made, where technology decisions are made, that becomes important, right? And so I think the question around where should it sit, I think it should sit in a place where it has that ability to engage with all the different businesses, the businesses it serves. It should have the ability to operate at that strategic level, and then have the right team and structure and financial incentives in place to be able to operate.
This is a golden nugget, that permission and ability to engage deeply,
Right.
widely, really, really matters. Now you talk about incentives. So I'm sure now people are wondering, what do you mean by incentives, and how are you thinking about incentives that drive the right behaviors?
Right. And when I say incentives, I don't necessarily mean these are incentives for the individuals, though that is important as well. And we can talk about that. But I think it's also incentives for the team in terms of what gets measured. How do you measure these things? And so at the business level and at the level of the team, I'm thinking about incentives to make sure that the strategic impact gets delivered with the right financial aspects in mind. I mean, I'm curious to find out how you think about it at TDK, right? I mean, you've been doing this for a little while, and I'd love to hear about that. I'm sure the audience would love to hear about that as well.
It's such an important question. What does success look like? It's interesting. Many times I go into a podcast and people say, oh, TDK Ventures, you are successful. And I always have to remind everyone we are not yet successful. We haven't brought billion-dollar businesses to TDK yet. We haven't returned more money than we've asked. We haven't had our fund returners. And I think before we got this through, I don't think anyone can qualify as a success. I think promising start maybe qualifies, but I wouldn't call it success. And so I always frame the success on our side as, can we really move the needle for the mothership? And when this is the size of TDK with more than 100,000 team members and $15 plus revenue per year, you're looking at billion-dollar moves. You're looking at business companies that really contributes to society, but contributes meaningfully to TDK. And I think our CEO is framing it really the right way, which is it's only pre-financial and financial. And the pre-financial is everything that's strategic that will then turn into a financial impact afterwards. And of course, if we start to return DPI and we return cash, that's financial. But everything we do in building equal win partnerships with our portfolio companies and other entrepreneurs and partners, that's in that pre-financial bucket that should drive improved roadmaps, for example, with TDK, better intimacy with future customers, partners, suppliers. So when we think about success, we frame it that way. And when we frame it that way, then the incentives start to make sense, which is the annual cadence of KPIs would be linked to strategic impact, while the financial returns is 10 years in the making. So this would not be in the annual KPIs, but would be more into a financial incentive like a carry. I think that's how we would frame this. But tell me how you've thought about it on your side.
Well, just on this particular topic, I mean, I think it goes without saying for most people that I have talked to in the corporate venture world that I think both aspects are important. Look, we exist for strategic reasons. I'm speaking of Citi Ventures, but we exist for strategic purposes and for strategic impact. And so we, have gotten good over the years of measuring that strategic impact using different metrics, because not all strategic impact can be measured with metrics or dollars or cents. So I think we've become better at measuring that. I think we could be even better. And then the financial return aspects of it are actually the easier things to measure and report on, right? So we do think about both aspects of it. One of the things that I think about is everybody knows about the power law of financial returns in venture. You have like the big fund returners, and there are a few of those big wins that drive financial performance. And then there's sort of a drop off. And I think that even strategic impact has a power law. I don't know if you've thought about it that way and you see it in your portfolio. There'll be a few of these fund returners as far as strategic impact is concerned. And then you really measure the metrics and the dollars and the cents benefits provided by those few fund returners, strategic impact startup companies, and then it drops down. And then there's sort of a longer tail. And I think that the strategic impact is probably, ought to be looked at in the same way.
I love the way you frame it. You will have a very few out of hundreds of engagements you may do over the last 10 years. Very few will really move the needles, but they will move the needle in a way that everyone will remember. And hundreds of them where you spend so much time on. Maybe it brought value, maybe it brought no value, but no one will remember them.
No, that's exactly right. And in most industries, whether it's TDK or Citi or any other industry outside of perhaps tech itself, they're familiar with startups. They read about it a lot more today than they did 15 years or 10 years ago. And there's awareness of it. And the impression is startups move fast. While that is true, the funds move slow. The funds are 10 years, 12 years, 15 years, and before I came to Citi, I was at a venture capital firm called Menlo Ventures. I've been at Citi for 15 years, but one of the funds that I was a partner in is still active. It still has investments in the portfolio, and it takes a long period of time for these portfolios to mature and for them to, first of all, turn DPI positive 1.0 plus, and then go beyond that. So at a fund level, you need to be thinking really long-term, and which means that as a corporate venture unit, how you measure performance, you need to be thinking long-term. Whereas many times the business unit leaders are thinking quarter to quarter, right? They need to hit different aspects and they get measured by Wall Street to hit those numbers. So there's that time element of it, which sometimes can be mismatched. And then the corporate venture unit and the leader of the corporate venture unit has a responsibility to explain how that works so that, it can be, again, set up and structured in the right way.
So let's shift gear towards people who are thinking about starting a CVC. So they would lead that proposal. Hopefully they become the head of that corporate venturing. And let's start with that topic of patience, because corporations are measured quarter on quarter, if not year on year. And like you said, it's a 10-year time frame when you invest in venture capital. And how would you advise that person trying to pitch? How should she think about pitching it with the right message on patience, while the corporation may expect something much more different?
Yeah, and I'd love to hear your views on this as well, Nicolas, but I think that it goes back to a couple of elements we we discussed a few minutes ago. One is, this is not a hobby. It needs a team of dedicated professionals to help grow it and deliver the strategic impact. And secondly, I think in setting it up, but also in communicating how this is best done, um, it should be communicated that this is a long-term business, to the point that we were making. This is a long-term business because of course, the financial returns will take time and for the financial profile to mature, but also the strategic impact. And so, preaching that patience, and setting it up for the long term, making sure that you're hiring the right people to set it up for the long term, people with an interest in doing this for a little while, because it's, venture capital is an apprenticeship business. You learn by doing, and then you get to see those patterns over time. And so I think setting it up for the long run is the right way to think about it, because hopefully nobody is going into strategic or corporate venturing thinking it's a short-term thing.
I think you touch on something so profound, which I confess I totally miscalculated. When I started TDK Ventures, I thought about it as it will take 5 to 7 years to get the returns. And so this is at least a 7-year commitment, which in corporation is a long-term commitment. Typically, it's like 12 duties, maybe 3 to 4 years, and then you move to the next promotion or next assignment. And here I was very clear this was at least 7 years. I'm now on my 7th year, and I'm realizing this is not 7. I think this is one of my biggest realization, which is I've actually committed 15 years into the same position, the same place, and growing it into something which I hope will really move the needles, both for TDK, but also for all the entrepreneurs who are backing. But this is not a 7 years. And if you think about people who are doing extremely well in the corporation, who think that starting a CVC is going to be a really nice stepping stone, they have to be conscious that this may actually be a place that they love so much, they are going to stick to it. And if they want to prove they're successful, this is not 7 years. This is a 15 years gig.
That's right. And to the point that you were making about corporate tour of duty, I mean, I think that many times a good corporate tour of duty could just be 3 or 4 years in a particular position, and then you move on to the next leadership position and you move on from there. And I think that this tends to be much longer than that to actually see the results of it.
Very nice. During your co-chairmanship, GCV got engaged more and more with VCs and invited them to events and making sure they have a voice. I'm a proud Kaufman Fellow member. I've attended after I started TDK Ventures because I felt I really need to understand venture capital. To be a better CVC or strategic VC, I need to be a very good financial VC.
Right.
I feel like the more we understand venture capital well, the more we are effective CVC. Can you speak to why, especially for those who are in the corporations or thinking about starting a CVC, why the VC part is so important to get?
The venture capital world, that's an ecosystem of its own, where there are certain sets of players, there are certain processes, certain industry standards. There are certain things that are done, things that are not done, things that are not done that might be done in a private equity world. So it's a world of its own, and it's in sort of a micro economy of its own and a market of its own. And so being very familiar with how that world works is going to be very important in driving the strategic impact, right? Again, stepping back and saying, we do this for strategic impact. Well, how do you drive the strategic impact? You need to find the right companies, invest in the right companies, have the right kind of partnerships. Well, how do you do that? Well, you need to understand the venture capital world. You need to understand the world of startups and how that whole ecosystem operates. And so actually, kudos to you for doing the Kaufman Fellows program after you got to TDK and going through that experience, because I think that accelerates your learning just in terms of how quickly you can get up to speed.
I mean, I can't speak high enough of Kaufman Fellow and the community it builds. I want to give another shout out. So I talked about Kaufman Fellows, but there's also VC Unlocked, which I did in 2020. So that was my first year at TDK Ventures. And it's a joint program between Stanford and 500. And it's 2 weeks. And every year I've sent one or two of our team members, and it allows for a common language as well. And so this is also something I would definitively recommend the audience to consider. Kaufman Fellows is very hard to get to, but VC Unlocked is much more approachable, and it allows to go from ground up and understand the power law and financials. And I think that's probably a good one. But I want to talk about GCV also, and I want to talk about it from a word you used earlier on, which is apprenticeship. And I feel like an industry, and I feel like we're moving from an apprenticeship augmented as an industry with better understood best practices. And so here I would like to hear your thoughts about how do we take this forward? How would you recommend me as chairman to really be impacting our ecosystem to become a better industry, behaving better, supporting better the entrepreneurs, bringing more value to our mothership? What would be your advice?
Yeah. Coming to GCVI, I think as the chair of the LSAB, I think there's a really great opportunity to shape the future of GCVI to fit the needs of the global corporate venturing community. And I think that the market evolves, and so we need to, as GCVI, serve the needs of the market at that point in time, right? And so one of the things that, Bill and I talked about a lot is what is changing and how do we continue to serve the needs of the GCVI community? So keeping current of trends, keeping current of current industry changes, keeping current of the topics, like LPs, investments or secondaries. Those are all things that I think we discussed it and I think will continue to be conversations. So I think staying current and tuning it to the needs of the GCVI community, I think is important.
And I think it speaks to patience as well, and the value of having people like you and Bill who've gone through many cycles. I think people who are starting a CVC today haven't seen the cycles. Actually, I haven't seen so many cycles myself. You have. And so I think that community of people who have seen the cycles, who can share their learnings from it, is so much more valuable than just being abstract. And so I'm hoping that you stay very involved and we can craft some of the agenda and some of the workshops together.
Yeah, and absolutely, I'm very happy to do that, Nicholas. And, to that point, one of the things that we had to deal with, and I'm sure you had to deal with in your own practice, is in 2020 when COVID happened, when the market goes down and is corrected by 20 or 30% and everybody is, really in a very different mindset. I think that creates opportunities. So we talked about how some great companies of today, household names, were created in 2008, 2009, 2010, sort of in the depths of the global financial crisis. And so entrepreneurs, technology trends, those things aren't necessarily following where the NASDAQ is. I think some great companies are founded sometimes in times of economic stress. And those examples help people understand that you need to have a sort of a consistent fundamentals driven approach to investing, not completely pull back just because the public markets have created, because as we've discussed, it's a very long-term business and you have no way of predicting, what the next 5 years or 10 years or 15 years will bring.
That's such a great golden nugget to end the podcast with. Arvind, thank you so much for taking the time, for sharing your insights and being so articulate and cogent about it so that the audience really can take the golden nuggets as they are.
Thank you, Nicholas, for having me. And it was a great conversation for the first day back. I really enjoyed it and look forward to having you as chair and for great things for the GCVI community.